Okay, well, good morning, everybody. Thank you. Okay, thank you very much. Good morning, everybody. Thank you for coming along today for our quarterly pension fund committee meeting. Firstly, shall we start off with any apologies?
We've had apologies from Aidan Dunn, but we have Sean Creamer, who's the new corporate director for finance and commercial, joining us today. Councillor Mark Roberts will be late joining the meeting, right? And will attend virtually. And Councillor John Beasley is joining the meeting virtually as well.
Right. Then on to the minutes from our last meeting on the 29th of November. Is everybody happy with those, or is there any points? Does anybody have any comments about the factual nature of the minutes, or are we all happy with them? No? Good. That's nice and easy. Yes, okay. Moving on then to declarations of interest. Does anybody have any declarations of interest to make? No, thank you. Good. Public participation.
Had no questions or statements from members of the public, Chairman.
Okay. We're obviously going to get an easy life for until we get to the details of the strategy committee, probably in the next meeting or so. Then any questions from councillors?
And we've had no questions from Dorset Council councillors.
Okay. Chairman. Any urgent items?
No urgent items, Chairman.
No items. Okay. Right. Then we get on to item 7, which is the Brunel Partnerships quarterly report. Over to you guys if you want to get it all in.
Does John Beasley want to introduce it?
Oh.
No, he's later on.
You're on mute.
Somebody's on mute.
Luke O'Donnell.
Can you all hear me now? Sorry.
Yes.
Okay.
Yes.
Can I just check you can hear me?
Yes. And I can hear Faith. Can everyone in your room hear Faith?
Yes. Luke, it looks like you've joined the meeting. It looks like we've got 2 Luke O'Donnells, so I think you might have joined the meeting twice.
Okay, sorry, let me get out of this one.
Faith, can you say something? Because I thought you were a bit faint. Can you...
I will speak up. There we go. Okay, I believe you have a very full agenda, so good morning. I ought to state my name because this is being recorded. So my name is Luke O'Donnell and I work at Brunel Pension Partnership. I've been at Brunel for about 2 years. Prior to that, I worked in fund management in the City of London and then for a small investment consultant in Bristol. I've visited County Hall on a number of occasions, and so a number of you might remember me. Naturally, I look forward to visiting County Hall at some stage in the future and seeing you again. David Wilkes has advised me you have a very full agenda today and asked that I keep my opening comments to 5 minutes. David Wilkes has also asked whether there would be anything forthcoming on Brunel's view of the Silicon Valley Bank issue that was discussed at ISG yesterday. That will be forthcoming a bit later today. It's just going through editing and then will be sent to you, and you can forward that to your members as you see fit. We sent you 2 reports. The first one is the Q4 2022 report, and then Faith has the climate change policy. And I should just state that lastly, David Wilkes, Councillor Canning, and your independent investment advisor, Steve Tyson, liaised with us, and in particular, David Vickers, my chief investment officer, on the 27th of February to review portfolio performance, activity and personnel. So if there are any questions that are lingering after I finish, please feel free to talk to any of those, because they got a fairly full debriefing on performance, certainly longer than the amount of time I have been allocated. Is it possible, Dave, you could share the, or has everyone got the quarterly investment report for the quarter ending 31st of December 2022?
Everyone should have that report, and Luke, yeah.
Okay, in that case, and I'm keeping an eye on the time, if you could turn to page 3. Page 3 shows you pension fund performance. Top left-hand side shows you the performance for the 3 months to the end of December. Positive 0.9 against the total fund benchmark 1.9. So on the face of it, a little disappointing. But if you look at the bottom left-hand side, you can see the relative performance of Brunel's active equity portfolios was broadly ahead of benchmark, with the exception being global small companies, which marginally underperformed. Sterling corporate bond and multi-asset credit produced positive returns ahead of their benchmarks. If you look at page 4, this is the asset summary, and all I wanted to point you towards was the left-hand side, which shows you the assets that have been transitioned to Brunel. So as at the end of Q4, your assets under management were 3.4 billion, of which about 72% had been transitioned to Brunel. About 28% is still in legacy assets. I should also state that if we turn on to page 5, there has been some further transitioning of assets during 2022 and also over the end of 2022 and into 2023. So during 2022, there were 6 tranches of redemptions from Schroeder UK Small Company Fund that went into Brunel Global Small Cap Equities. That was completed in 2022. And then we understand you are exiting your Insight LDI program. And so there have been assets transitioned within page 5 on the equities side into CTB passive equities, which is climate transition benchmark equities, and PAB equities, which is Paris aligned equities. And you have invested in both the hedged and the unhedged version of those passive equity funds. There has also been, if you go to the bottom left-hand side of page 5, some top-ups into multi-asset credit and sterling corporate bonds. Is that all okay so far? Are there any questions or comments?
Peter.
Yeah, thank you for that. Just a general question on the asset split. And you make the point that 28% is currently still in our control, or whatever words I might use for it. I absolutely get the fact that when we started this process, we wanted to achieve better margins, and we would do so. But the fact is, some assets have been quite difficult to transfer. What I want your assurance that you're not going to transfer assets and just incur a churn on our behalf when actually they're better off where they are. So can you just assure me that we will take into account the cost of the churn rather than just maybe just plough ahead with moving everything into Brunel, which I personally think we've probably got about the right percentage at the moment. And the subsidiary question is, what do you see, assuming that we're now on a slightly plateauing trend, what do you see as the likely long-term percentage of Dorset assets rather than Brunel assets?
I think part of that David can answer.
Yeah, so just to respond to that, Councillor Wolf, I think the decision to move any assets across from existing legacy arrangements that are outside of the pension pooling is a decision for you, the committee. It's not a decision for the officers. It's not a decision for Brunel. Brunel are just there to implement our wishes on that. I think the second part of the question is, what do we see as the right level? I think we have got some of our conversations later on the agenda may look at some of those asset classes or arrangements that are still outside of pooling. The original guidance from the government was that they wanted LGPS funds to move substantially all of their assets under the management of the pools. We have been waiting for revised and updated guidance from the government on this for a number of years. I'm sure, again, this will be something that will come back on the agenda later. So there are members of the committee may be aware that there are some funds that have not transitioned any of their assets across to their pools. I think some of the London boroughs in particular. But I think, you know, in Brunel, us as Dorset, we have transferred the best part of 3/4 of our assets across now. And I think that across the 10 funds that make up Brunel, that percentage is probably in the kind of high 70s, I would say. So I think, you know, we have made a lot of progress on that. But just to reassure committee members that the decision to move assets, any further assets across, will be your decision.
Yes, I mean, amongst the assets that we probably won't move across, things like private equity, infrastructure as well, where we've made individual investments and there's no intention to switch those over. The biggest question mark will probably be that needs to be decided in a couple of meetings as part of our strategy is what we do about property, how we manage the property side of things, and how our relationship with CBRE evolves. And I think we've got some ideas there that we'll deal with them in far more detail later on.
Yeah, I'm comfortable with that, but, and there is a but, you know, when you say it'll come before this committee, you know, if we're talking about some very small amount, will it come before this committee? But I just want us to think strategically that, you know, particularly property, I personally don't see any benefit in transferring property at all. I think we'll just incur a churn and achieve nothing, unless we want to change our overall balance. So I actually think it's a rather more nuanced decision than just looking at an individual asset or an individual asset class. So all I'm asking is that, you know, we don't pile into this and we give this really good early thought, because this isn't just a matter of saying, oh, we need to improve our ratio under pooling to nearer 100% because we make a bigger margin. Because I think we've achieved what we set out to do, I think. And I think any further transfers need to be really carefully thought out.
Yeah. Thank you.
And can I just say, Councillor Wharf, that we have engaged with your independent investment advisor and Dave Wilkes regarding property, and currently the cost looks prohibitively expensive.
Sure. Well,
as things stand.
I'm grateful that you say that. I mean, property was a brilliant asset class for a while, not been so great, but moving it achieves the Q root of nothing. So
Can we?
We are straying into territory that might be discussed in the exempt business as well at some point. So can I just, I mean, I'm not trying to close this down. I mean, the property section will be debated properly and fully, but this is not necessarily the time to do that.
I just wanted to establish a principle that we weren't going to.
I think we might well be all in a similar position.
I was just going to mention the cost of property comes up in a later paper.
Okay, your legacy assets are on page 6, but if we just go back to page 5, and again, you look at the top left-hand box where the equities are, 5 of the 14 strategies are active strategies. Therefore, they are aiming to outperform an underlying index by various degrees over rolling 3 and 5 year periods. 9 of those strategies are passive. So all they're aiming to do is match the index. So hopefully this is unsurprising to you, but when we liaised with David Wilkes, Councillor Canning, and your independent investment advisor, the key area of focus was on the active portfolios, and that is where I am going to quickly sum up a few points on performance, because I'm aware we're eating into time already. So still on page 5, the largest of your investments in active equities is global sustainable equities. Over Q4, it achieved a positive return of 2.4%. The details are later in the document, which was 0.5% ahead of its underlying benchmark. Stock selection was key here, and one of the things I'm sure your committee is very aware of is that in some market instances, it's not necessarily what you own, but what you don't own that gives you good relative performance, and that was very much the case in Q4. In the Global Sustainable Equity Fund, there was no Apple shares at all. Tesla was an underweight, as were Microsoft, and they were positive relative contributors, being underweight or not owning those stocks that performed poorly. I should probably just flag that Global Sustainable Equity, as David Wilkes will have found out yesterday, had a very small holding in Silicon Valley Bank, 0.48%, and that has been written down to zero by the manager who held it, a firm called Mirova. Global High Alpha is the second biggest position. Over Q4, Global High Alpha was positive 2.7%, so 0.7 ahead of the index. On sectors, there was a headwind, but again, stock selection was good. So being overweight quality entities such as Nike, MasterCard, Oracle, etc. was positive, and underweighting in large tech, such as Tesla and Apple, again, were also positives. So that was quite healthy as well. Global small cap equities is the third largest active equity position you have. This is the one that unfortunately underperformed in Q4 by 0.5%. Sector, style and geographic split were all headwinds for the strategy there. UK active equities produced a good return of positive 9.6%, which was about 0.3% ahead of the prevailing index. The overweighting to financials was positive, but I think you know that we're not big fans of the banking sector. So the financials overweighting was in insurance, Legal and General, Aviva, Just Group, and the underweighting in energy was also a positive during Q4. Emerging markets is the next largest active position, generated a return of 2.3 over the quarter, which was 0.4% ahead of the target. One of the managers we've had on watch for a few quarters, Genesis, had a very good quarter. They have done exactly how we would expect them to perform. They did very well with the reopening of China. Wellington also prospered from that. 91 had the least Chinese exposure, so didn't perform quite as well. And finally, summing up, in fixed income, multi-asset credit produced a positive return of 3.7 against cash plus 4 target of plus 2%. So multi-asset credit has an upward only target. And over Q4 was able to beat that target. Sterling corporate bonds 6.2%, a little bit ahead. And then moving to the right-hand side of page 5, diversifying returns fund, that has a cash plus 3 target. It produced a positive return, but was marginally behind that cash plus 3 target. And that was all I was going to say in the 5 minutes, which I have woefully overspent of your time.
Okay, any questions? I think, sorry, go on, Steve.
I'll ask a very quick one, which is that, Luke, when we met at I always like to know how things are going at the moment. When we met in February, you mentioned, you and David mentioned the fact that you were almost overall, but I'm just wondering, you mentioned in your comments that you're underweight financials, but you're probably also overweight technology. And I'm just wondering whether you've got, it's possibly too early to say any net feel for how the funds are performing in the past few days when we've had this financial thing going on globally, but also technology underperforming.
Yes, the funds have held up as we described to you at the end of February. And the fund we were particularly concerned about, the Global Sustainable Equity Fund, because of the holding in SVB, that has continued to generate better returns than the prevailing index. So even taking that hit on about half a percent of the portfolio has not been detrimental to relative performance, but we still have 2 weeks or so of the quarter to go.
Okay, thank you.
I think it'd be fair to summarise that the performance, broadly speaking, has been improving and good recently, but we still have a bit of a make up to go position a year ago when the Ukraine position blew up.
That is a very fair sum up, because when the Ukraine invasion occurred, being broadly underexposed to fossil fuels, carbohydrates, all those types of things, was for a very short period not the place to be. But the hit we took in Q1, which actually when I came to see you, I flagged pretty clearly to most of you, that is going to take a bit of time to get over.
And going forward, how do you see the world's economy going in terms of fossil fuels and all that side of things?
That might be a chance to introduce Faith.
I thought you might pass me that one. Are you happy if I take that, Chair?
Yes, by all means.
Yeah, I think inevitably, but it's difficult to judge. I think obviously the short term sort of energy security and the focus on that is inevitably meaning that particularly in the short term, there has been an increase in fossil fuel consumption in order to meet those needs and to sort of rejig plans. On a more medium to long term scale, it seems to be escalating the demand for energy security and interpreting that to be on kind of domestic resources, which obviously renewables and alternative energy sources sort of play quite strongly into that kind of that demand. So you're seeing kind of an escalation of policies to kind of look to see how we can up across Europe, America, and as you say, you've got the largest infrastructure investment the world has ever seen with the US and its Inflation Reduction Act, just showing you the kind of expectation and the demand that's likely to bring with that. So in the short, so there's a different sort of answer to the question whether you're looking kind of in the short term to the medium and long term.
I think we accept that, certainly. But yes, you're right. I suppose energy security has become a sort of more dominant issue rather than the pure environmental things. But I mean, sometimes get the impression that pretty much every Western government now seems to be putting significant investment into alternative energy sources. Would you say that was fair to sum up?
Yes,
Obviously,
no, absolutely.
the US we know about, but some of the others as well are actually putting a lot of resources into this.
Absolutely. So we have the Fit for 55 EU kind of rollout and its net zero planning. So that sort of is quite extensive in terms of its targets for renewables and alternative energy sources. We're expecting in the coming weeks for the UK government to issue its kind of updated sort of strategy around some of these areas, and we'll get a bit more clarity, particularly around the finance aspects of that, which I'm hoping will provide some clarity from a UK context. But yes, so broadly speaking, you're seeing people see this as an impetus to accelerate what was already kind of happening with regards to sort of renewables and removing kind of dependency. Because I think the challenge we have with energy is that our energy sources come from places, our sort of fossil fuel energy sources come from places that are problematic from a governance and other regions, even sort of, flipping between Russia to sort of the Saudi Arabia, it comes with challenges with that. So I think people seeing that sort of more domestic supply. I think you're also seeing an increase in nuclear as well in terms of looking at that and people reflecting, and you've seen a sort of a change and shift in the thought processes around that also happening.
Yes, that's something probably we don't hear so much about, but yeah, that makes sense. Does anybody else want to? Sorry, that's all.
I don't wish to dispute what you say, but there is also quite a lot of effort being put into governments reopening coal-fired and oil-fired plants. And there are a number of what we used to call in the industry midlife upgrades being applied to these centres to keep them going for longer. So I think, I'm just trying to present, you might not agree with it, but I'm just trying to present a rather more balanced picture, which says that actually quite a lot of governments are putting quite a lot of effort into extending the life of plants that they previously intended to close.
No, and that's how I opened my statement, which is in the short term, you are seeing an increase in that fossil fuel consumption. So I don't disagree with you at all, Councillor.
Okay, thank you.
Does anybody else have any questions on the performance side of things particularly? Yes.
Yes, not quite so much on the performance. I just noticed in the report it talked about the Brunel's annual general meeting, which took place last Thursday, and it said a verbal update will be provided with this meeting of the Pension Fund Committee. I don't know whether there was anything worth reporting or updating from.
On that. If we once we've Brunel have concluded, if we've also got an item on the agenda, Councillor Beasley providing a regular update. I think if we'll dovetail that into there. And
yes, okay. In which case, do you want to say anything more about the Brunel's review of its environmental policies?
Yeah, so if I give you just a quick synopsis, because I was asked just to give like a kind of a brief overview and then open for questions. So Brunel updated its climate policy, and that was published last February. It was one of the outputs from a stock take process that we've been undertaking in 2022. That was very much an opportunity to kind of step back, evaluate what had worked well, what had not, and most importantly, what we'd actually sort of delivered, which includes that 7% target per annum for all of our listed equity portfolios that we set back in 2020. And I'm delighted to report that we did do that across all of those areas. In fact, in aggregate, if you took our asset allocation as being the combined asset allocation of our underlying funds, we had a 35% reduction in that sort of carbon intensity, although it varies from sustainable equities, just comes in at 21% through to emerging markets, which is 45% less than its baseline back in 2019. So, but what we also learned from the stock take process is that number is not particularly helpful in telling you the whole story, as probably illustrated by that kind of some of those sort of changes between our different portfolios. And then we need to actually decarbonise our whole economy, as we've just been talking about, not just your portfolios. If we are actually to genuinely reduce the sort of financial risk to the fund, I think understanding kind of what that real world economy and being able to kind of have better measures of success was some of the clear messages that we heard when we reached out to stakeholders. We did quite a lot of stakeholder dialogue with yourselves, with deep dives with David was part of two deep dive sort of client workshops that we did. We did surveys, and we tried to gather in all the evidence we had, because it's obviously for us, it's about, are we delivering for the client's needs, and what are the sort of the key messages, and that real world impact, that real economy impact, and measures of success, or being able to measure our progress better, sort of were key components of that. As to the policy itself, it very much built on what we did. The feedback we got was that the basic premise of it was still fit for purpose. So we reaffirmed our belief that we think pursuing efforts to minimise the impacts of climate change and pursuing sort of to try and limit that increase in warming to 1.5 degrees is consistent with our sort of fiduciary duty. But we actually need to systemically change the financial system. It isn't geared to that outcome particularly, and we still need to make progress on sort of transitioning, if you like, our economy and Brunel's role within that. The policy originally had 5 pillars, and those are all again agreed with the underlying sort of clients and the pensions committees. And those are policy. We need that sort of supporting policy backdrop. We talked about governments and their licensing and around fossil fuels, about renewables, that sort of longer term kind of perspective we need. It's definitely been a mixed bag. It'd be fair to say since 2020, some quite positive developments, but mixed with some headwinds as well. Products, so you have somewhere for the asset allocation. So we need to have a range of products that allows you to asset allocate to achieve your objectives, both from a climate and financial perspective. The portfolios, which is the day-to-day management and implementation by the asset managers. Positive investment, where we can sort of make some positive contributions to things that to deliver sort of the transition. And persuasion, this is our stewardship and engagement program with the underlying companies and assets in which we invest. So that's our 5 Ps, our policy, products, portfolios, positive, and persuasion has been that kind of the 5 pillars as how we will deliver the policy. And just to end on, although it has been pretty challenging environment for any topic around climate, certainly in 2022, I think just perhaps to end on a bit of a positive note, persuasion was one of the areas where perhaps we didn't succeed as much as we thought we might do in terms of how corporates would actually respond, or the actions that they would take. But one of the areas that we bring out more and we're going to use more extensively going forward is the Climate Action 100+ Net Zero benchmark, which is a way looking at the performance of the most carbon intense companies across the world. It looks at sort of 159 of those companies across a whole multitude of sectors. We own, Brunel has exposure to 122 of those. Of those 122, 82% have made a clear commitment to net zero, 95% have declared a board level accountability for climate change, and 97% have committed to TCFD, or a task force for climate related financial disclosure like like reporting. So although these are still sort of at the commitment rather than delivery, and some signs and some hopeful signs that we are sort of making progress in terms of that sort of corporate response. So that was literally a tiny drop of the to just to give you a bit of a warm up to the policy itself, and I'm open to sort of answering questions on the detail.
Thank you very much. I think it's very thorough. Steve.
Thank you for that, Faith, and well done on the climate policy. I suppose that I'm thinking about the fact that you mentioned there that persuasion doesn't always work. It's one thing for the countries to make commitments to net zero, but at the same time, it's the action that's the important thing in the long term. So, and I've got in mind the BP case where they backed off some of their, they're starting to open some oil fields or whatever. They're backtracking a little bit. So that sends a signal, I think, a little bit, and that was in response to the fact that their share price wasn't being rewarded for their commitment, whereas the share price of some of their American competitors was being rewarded for being dirty. That's how I have interpreted it. So what are your thoughts around that, really, in terms of, we need to move forward to so when does your patience start to kind of run out a little bit?
Excellent. So just to be clear, so Brunel doesn't have a mandate for any kind of exclusionary policy. It needs to do it through kind of looking at the investment lens. So it is a very investment driven process, and it's about working with the asset managers who are selecting those stocks. So it's looking at it sort of with that perspective. So the patience has to be a patience of combination of kind of the financial risk presented from that climate change and that potential sudden correction that might occur, that Minsky moment, I think, as Mark Carney, when he's in the Governor of the Bank of England, called it, where we might get a correction in terms of that sort of fossil fuel commitment. I mean, if I can talk more generally, and then I'll pick up specifically about BP. So in general terms, what we have defined in the policy much more clearly, because we were able to sort of progress and mature things, as it were, from 2020, is a process by which we have these indicators which will tell us where the companies are in terms of their alignment maturity. So the key thing is, are they aligned with the objectives of the Paris Agreement? Are they aligned with the climate transition? And the plan is to use those indicators as a framework to define what Brunel collectively, in conjunction with its clients, think is an appropriate level to define a company as being controversial in respect to its climate alignment maturity, identify those companies and evaluate the risk of those with the asset manager, and then identify steps for action. So at the moment, we've identified that as companies that fail all of the climate action indicators. In other words, they're not fulfilling any of those indicators. There are 3 companies that we own that fall into that category. Berkshire Hathaway is the most significant, and 2 emerging market companies. The 2 emerging market companies have actually made net zero commitments that are quite extensive, but they're just not flowing through to the indicators just yet, because of the way that the time cycle in which that is evaluated. Berkshire Hathaway argument from them is that because of their diversified nature of that particular conglomerate, they can't possibly do a TCFD report or report to net zero, for which I have very little sympathy as somebody that has to do TCFD across a much larger number of companies. Essentially, a pension fund is a conglomerate of a lot of, this is an investment trust and some. So I have very little sympathy for his problems on that score, but they have committed, and obviously the regulatory requirements in the US are moving, so they were likely to get those coming through. And in fact, the utility owned by Berkshire Hathaway has made a commitment to shift more significantly to renewables going forward. So having then evaluated in deeper depth, basically the plan was not to exit any of those companies or to working with the manager. We didn't feel there was an investment case for doing so. But the idea is that process will go around each year, and collectively the clients will kind of engage us to kind of and be aware of kind of the process where we're ratcheting up, if you like, the maturity, as you say, in terms of what are the expectations on company and how are they fulfilling them. So that's how it's going to sort of work going forward. So we've got much more of a framework to evaluate, because up to date it's been a bit more kind of, how do you sense the company's doing? It's been very, very hard to actually evaluate it in a systematic and consistent way. With respect to BP more specifically, I think it is part and parcel of this general kind of challenge that we have had with the sort of the energy crisis. We have reached out with BP and Shell and are engaging with them and escalated that in combination with a number of other investors. They obviously have a net zero plan. They had strategies that get them there. So I think the challenge is that they aren't amongst the worst when you look at their commitments and the actions that they're taking within the oil and gas sector. But yes, this reversal in terms of their commitments is concerning and is something that we're taking action, as I say, alongside other investors. In terms of our patience, it is more challenging to kind of define that and work out when that is, particularly when you've got sort of profitability in this sort of short-term kind of investment needs as well as the longer ones. It is a balancing act that we have to try and navigate. I mean, the fundamental flaw as to why BP is not being credited for the actions that it's taking is the lack of a price on carbon, and comes back to the policy debate and the lack of policy clarity. Although we've had these, as I say, it's been a mixed bag from a international policy perspective. We've got some real strong commitments around renewables and infrastructure rollout, but not a corresponding clarity around what not to invest in terms of, we can't just keep producing more energy. We actually need to have less coming from those fossil fuel reserves. And so it is about efficiency as well as energy consumption, but actually how we move the economy away from fossil fuels is less clear. And so that's why I think it's not priced into BP's.
Anybody else have any questions? No? In which case, thank you very much for both of you for joining us this morning, and it's been very interesting as always. Thank you.
Thank you.
Right.
We step off now.
Good morning, John.
Good morning, Chairman. Good morning, committee. I'm sorry I can't be with you, but I have another commitment at lunchtime, and I physically can't get from Dorchester to that before the other thing starts. So otherwise, I would have been with you this morning.
That's perfectly all right. But, yes, over to you for your report and update, please.
Well, I'll be doing this obviously in two parts, and partway through the second of those parts, which is the Brunel piece, I'll be asking David Wilkes to come in on something specific regarding the shareholder. But if I could start first with the Scheme Advisory Board. As you know, I was appointed to that 2.5 years ago, and as one of only 5 councillors across the country on it, it is a great insight for us as Dorset to know what is happening at the national level with regard to the LGPS in particular. So I won't go through all the many items that are on each agenda that I have to attend, but most specifically, I just wanted to have a word on the Scheme Advisory Board about the government's pooling consultation and where I think the board see that going. So we have a link person, if you like, from the department, Teresa Clay, who, if you like, liaises between the Scheme Advisory Board, representing the LGPS across the country, and the Minister and the department. And that's a very interesting way of trying to measure what the government's intentions are. So the consultation's been a little bit delayed in terms of its outcomes. We're hoping it's going to come forward relatively soon. And I think one of the things that's muddied the waters has been the inadequate way, as the government see it, and many of us see it, of some funds in terms of actually complying with the spirit of pooling and the transition of assets. We, Dorset and Brunel, are not amongst those, obviously, and I think we're regarded by government as being exemplary in terms of taking it forward within the spirit of the government's intentions, and in fact taking it towards other areas such as particularly responsible investment and being a leader in the LGPS in that regard. So we're not under any kind of scrutiny, but I think what's delaying things is that the government don't see this intent happening everywhere. think reference was made to some of the London boroughs earlier, and we know of other pools which aren't really proper pools in terms of making sure that the spirit of it is entered in across the piece. I don't want to name any of them on a public meeting, but it is a matter of frustration, I think, to government, and we're worried that they may come back and use a more arbitrary approach to the LGPS. I don't think that's something the government have got particular appetite for at the moment, but I do think that they will come back and revisit what they've said about infrastructure. And we, of course, in Dorset and through Brunel, I think, again, are complying with the spirit of it. So I don't think we've got very much to worry about. But as I say, I'm worried that nationally, this government or a future government may take a more arbitrary approach across the whole of the LGPS. That's about all from the Scheme Advisory Board. If you'd like me to go now to Brunel, so there was a Brunel Oversight Board meeting last week, and since we last met, there was another one on the 26th of January. So I'll bring the two of those together. And I suppose there were three areas that you asked me to press on with regard to Brunel. I think the first was around reporting. I get the impression that most people think that that is greatly improved over what it was, say, 6 months ago. But I would like you, as our committee, to be feeding into me if you see other areas, not necessarily now, but in the future, where you think that can be improved. And I will represent that as strongly as I can. I think the quality of reporting has improved, but I think that's critical for us in Dorset to be able to do our job. And so I'm very pleased that it has, and it's a more targeted reporting process now, so that we're getting the information we need in the style in which we would be able to absorb it quickly. But please come back if you feel we could do more. I suppose that the second area was around performance, and as we've seen, that has shown some improvement over the last quarter. But as has been mentioned, we've still got a bit of catching up to do. And the third area was about making sure that the officers of Brunel are integrating their thoughts and attending our meetings so that we can not only hold them to account, but we can get a free flow of information so that everybody on the Dorset committee knows that they are part of Brunel in the sense of playing a part in Brunel. I think that's really important. And so I will continue to press to make sure that we get that representation at our meetings and generally at the highest level where that's a possibility. But of course, remember, there are 10 funds who each hold quarterly meetings. So there's quite a lot of effort required away from the day job for senior people in Brunel to do that. But it is important to us. We're custodians of those funds, and now that we're transitioned to 70% or so, they're holding a lot of our assets on our behalf. So I will continue to press for that, and I know that David and Aidan are doing likewise, so that we get that interface at our quarterly meetings. Specifically, out of the last two meetings, I suppose what has occupied minds has been the issue of the special reserve matters, as they're called, which are issues that need the authority of all 10 funds to proceed. And generally, that has proven to be relatively straightforward. You'll remember that I've reported previously that there were a lot of governance issues, probably 18 months to 2 years ago now, where some of the funds were very, very unhappy about the governance arrangements. A lot of work went into that, and I think we ended up in a much stronger position as a result. But to a certain extent, these special reserve matters, which came up only last week for ratification, have been in large part agreed by all 10 funds, but we have got some difficulties over what's called the people strategy, and that requires shareholder approval. So David, Aidan and I have had two online conversations about this, and I think we'll be having another one before the next Brunel meeting to see whether this can be ironed out, whether we can get some stability. I obviously was not at the shareholder meeting last week. I know what occurred, and I just wondered if David could update us on where we are on that, and then I will come back and make some comments about where I think we should be going. If that's agreeable to you, Chairman, could we just hear about the shareholder part first, and I'll come back.
Okay, sure, that's fine.
Yeah, thank you, Councillor Beasley. So after the Oversight Board meeting in the morning, there's a meeting of the shareholder representatives in the afternoon. The Dorset shareholder representative is Aidan Dunn, who's our Section 151 officer. And the majority of other shareholder representatives are the equivalent at the administering authorities for the funds. There are some exceptions where there are pension fund committee chairs are the Oversight Board representative, but they're also the shareholder representative. So the sticking point, I think, that Councillor Beasley is referring to in terms of the people strategy, I think the very specific thing that is proving to be difficult to get all 10 funds to agree to, all 10 shareholders to be specific about it, is in relation to benchmarking of salaries for Brunel's officers. So Brunel's a strange position in that it's come out of local government, but it's kind of competing for staff within the investment industry as well. And as is the case for many areas, the market for people is very challenging at the moment. The proposal that's been put forward by Brunel is that in order to improve their ability to recruit and retain staff, that they're looking to be able to benchmark their salaries against other pools. So the other pools, so then looking to benchmark salaries against the Black Rocks and the Insights and the various other fund managers. It's against other pools. The view that Aidan and John and myself have is that we should be. It is the reality of the situation. We can see that there are members of Brunel are leaving, and one of the factors is pay. I think the view that we have is that we should be giving Brunel the tools to deliver the investment performance that we're looking for, and not trying to micromanage them too much in terms of how they do it, but that we should be looking to hold them to account for that investment performance. So as we've been doing this morning. So the situation we have at the moment is that there are 8 funds that are supportive of the proposed changes to the people strategy that have been put forward by Brunel, and it has, as Councillor Beasley said, this has been through many conversations at many levels over the last few months. But there's one of the funds currently are unable to agree to it. Well, two actually. One's taken a slightly nuanced position in that they've kind of sat on their hands a little bit, really, haven't really decided one way or another. So at the shareholder grouping, Aidan, unfortunately, the one shareholder that has voted against it was not actually able to make the meeting, so was represented by my equivalent at the meeting, which I felt very sorry for her to be put in that position. But the result of the meeting really is that a small subgroup of the shareholder representatives, so Aidan Dunn from Dorset and Robert Gould, who is the shareholder representative at the Environment Agency, are going to meet with the shareholder representative for the fund that hasn't yet been able to ratify, if you like, the changes to the strategy. So that's where we are with that. I don't know if did you want to add anything, Councillor Beasley, or to that?
Well, Chairman, I just wanted to get that background, given that I'm not the shareholder. and I wanted the committee to understand that important difference. And I think what we will be doing, that is Aidan, David and myself, will be reconvening as soon as that meeting has taken place with Aidan and Robert, with the shareholder who's, if you like, dissenting. As far as I'm concerned, these issues are very well set out in the papers that we've received and we've gone through thoroughly. And there is an element, if you like, of micromanagement, because we've given Brunel some very tough asks in terms of where we want to see performance improved. We've got to have the right people to do that. And I think it's a big distraction for the executives of Brunel that they've got this hanging over them, because they know all about it. They know that it has hit a big sticking point, and that for morale is really not a good thing for a fund of this size. Remembering that, you know, in total we're talking about funds under management of somewhere approaching £35 billion. It's a lot of money, and our best interests, I think, are served by letting them get on with it with the best people available in the market. And I think that as a distraction of management time, it is something that's not going to be terribly productive for performance. So we recognised that all the way through. What was interesting at the last Brunel meeting is that the chairman went round each of the funds in alphabetical order of those sitting on the oversight board to ask them about their views on where we got to on this particular special reserve matter. This is the third SRM. The other two went through very smoothly. And it was interesting because of the 8 of 10 who had supported it, there were some very strong views of support, actually, stronger than I was expecting, about how we've got to get this thing knocked into shape and to allow Brunel to get on with the job. And I spoke along fairly middle lines, I suppose you might say, but I'm keen to do anything I can to try to help to get this problem resolved across Brunel as well. And we mustn't allow it to drag on. The issue I referred to earlier about governance issues did drag on for too long, was significantly undermining for a period of time, when actually I thought at the time, and I think now, those people should have been brought into the room so that we actually got to a decision that everybody could live with, because it was always going to be the case with 10 funds and innumerable people involved in each of those 10 funds that there would be bumps along the road. And this is a reasonably significant bump along the road, and it's for us collectively to get it resolved. And I think that was the view of the overwhelming majority of members of the Oversight Board. The other thing I just wanted to mention, and you touched on this earlier, Chairman, was with regard to transition. Yes, we are 70% or so, 72% transitioned into Brunel as far as Dorset's concerned, and there are some of the 10 funds who have transitioned more. But I think that the reason is, as you've probably identified, that we have a lot more illiquid assets, because those asset classes are ones we've chosen within our existing investment strategy to pursue. We may change that in the future, who knows? But in the meantime, I don't look upon it as a lack of commitment that we're only 72% transitioned. We're not in a position to do the rest at the moment anyway. And there are one or two other funds in a similar position to ourselves, whereas there are some funds that are up in the 90% because presumably they didn't have the same degree of illiquid assets. And remembering, I think the Vice Chairman cited property, we are the only one of the 10 that has real estate within our pension fund. The others are all in property, but not by direct investment. So I don't have any cause for concern in that respect, and I think that's well understood by all parties. So on any of that, Chairman, if members want to ask me any questions or want me to follow through with anything on behalf of this committee, I'm happy to do so.
Thank you very much, Councillor Beasley. That was very, very thorough. and I really appreciate what you're doing there. Is there anything more that this committee can do to help the position, or is there anything we can put more pressure on, or anything that make a difference?
Well, Chairman, I think in answer to that, the timing of these meetings wasn't perfect, because obviously, ideal world, we could have had this discussion before the oversight board meeting. So when I discussed it with Aidan and with David, we wondered whether we should do that. We thought we had the authority to proceed as we have done, but I wanted to report back at the earliest opportunity. What I need, and I think what your officers need, is to know that the committee is foursquare behind the position that they have been taking. And if we've got that confidence, then you need to leave it to the positions that we've been appointed to, and we'll carry on in that regard.
Okay, Councillor Wolf.
Yeah, John, thank you as always for your extremely diligent involvement. I've got 2 or 3 questions which may sound slightly unhelpful, but they're not meant to be. One is, are we getting involved in internal Brunel machinations when actually what we want is an outcome, not to be involved in their own operations? And I'm just worried that we're getting slightly too involved. We went to Brunel and we had no intention of involving ourselves in their internal machinations. We had a template and we had a metric that we wanted them to achieve. And my second question is, has this affected their performance in your view? And my third question is, just looking at everything else aside, is their performance good enough at the moment? Because, we have to ask these blunt questions. I'm just worried we're getting a bit sidetracked. We actually have to go back to basics. Is it good enough? Because I have to be honest, I don't think it is. It's not bad, but it's not good enough. And do we feel confident that they are going to move into the right space where it is good enough? So I don't get me wrong, I'm incredibly grateful for your work, but I think we need to step back and say, are they doing what we wanted them to do? And if not, have they got a plan to bring it into line? Thank you.
Well, thank you, Chairman. I'll respond to the Vice Chairman in probably the reverse order of the questions he asked. In terms of performance, that is the most important thing to all of us, isn't it? Yeah. Absolutely right. And we have been making sure that we're holding Brunel to account in that regard. And I think we certainly, whenever we've had challenges that we've made to Brunel, they have come back and they've responded. But there is always room for improvement, isn't there? And that's what we want to see. That's absolutely what Brunel was there to do. It was to save costs and improve performance. If we want to transition more assets, we may need other funds in which to place those assets, and that's for us to coordinate with Brunel so that they've got the right investment vehicles for us. For us, it's really important that it fits our investment strategy. And I think that there has been some improvement, but it's only very recently that we've seen that. I'm sure that we've all listened carefully to what Steve Tyson has had to say to us as our independent advisor. And Steve, having seen the other side of the fence in the past, understands how it operates better than probably almost anybody, and knows what questions to ask and how we best hold Brunel to account and improve performance. So there's no lack of will to do that, and I think that gets reflected in the oversight board by the overwhelming number of people doing what I do there as well. But of course, it's what happens outside the meetings that's more important, isn't it? And so we need to keep totally alive to this issue of performance and making sure that it doesn't become some sort of cosy arrangement that doesn't have that degree of challenge. So that's for me the critical part. In terms of where this becomes a distraction and takes the eye off the ball, which was, I think, your second question as far as Brunel officers are concerned, I don't think that's happened yet. because this is all relatively new. So it happened in the last meeting in January to some degree, and it happened last week. But it cannot go on, because if it does, it will then become a distraction, and that inevitably, if you get people leaving, or you can't attract the best people, it isn't going to improve performance. That's just a fact of life, I think, and it isn't put up as an argument for increasing pay all on its own. And I think that's where some people perhaps in a couple of the other funds haven't completely understood the bigger picture. I don't think I ought to say more than that, but I'm sure you understand what I mean. And the first issue you raised was, are we getting involved in the minutiae of the operational side, which we all know as members we wouldn't and shouldn't do. No, I don't believe that's the case at all. These special reserve matters within the constitution of Brunel are ones that quite properly come to all 10 funds for ratification, and the current structure says that it has to be unanimous. And if it isn't, it doesn't go through. So the first two SRMs went through, this one, the people strategy, didn't. And we therefore need to make sure that we get them through, because otherwise nothing will change. And if nothing changes, I suspect that performance for a lot of reasons will suffer. So we're not getting too involved in the details, but we're quite legitimately involved in this. In fact, we have to be involved in this. We have no choice under the structure as it exists.
Do you want to follow up on that? Anybody else? David.
Thank you. Yeah, thanks, John, for the update. Just trying to get my head around, obviously, the special reserve matter, and I agree with a lot of what's been said already about not wanting to get too much into minutiae, and we need to get this resolved so that things can sort of move on and we concentrate on performance. But I'm just interested in the sort of options there are. Obviously, if there's a couple of funds within the pool that are not going for this sort of the approach that the other 8 are going for, what options are there to sort of resolve it and move ahead, or is it just a case of keep trying to bring those couple of people along with the others? And I think I was right in saying you said the approach is to allow Brunel to sort of align with what other pools, that's their sort of remuneration strategy, to be aligned with what other pools are offering and benchmarking with other pools, which I think sounds sensible to me. I'm just a little concerned that in essence that sort of almost means we're leaving it up to other pools to decide how they approach it, and if they all go a different way, it's almost that a little bit they're almost making our decision for us, sort of thing, rather than us saying, oh, we're going to align with this or align with that. We're going to say, well, we'll align with the pools, and if they all decide to do something different, then that's just a little niggle I've got in the back of my mind, that it's, well, okay, we'll align with the other pools. If the other pools go a different way, then we're sort of stuck with that. If you see what I mean? Yeah.
No, the only thing I was going to just say there is it's a good point, but being the pedantic person that I am, it is benchmarking against other pools. It's not aligning with other pools, so it doesn't. And as I think Councillor Beasley has alluded to, it's there, and it's there for targeted use. And the feedback that came from us and through Councillor Beasley in particular is we want to. This is not a free for all to give them all pay rises. This is a targeted approach, and we need to understand, why and when it's needed. But as Councillor Beasley said, as Councillor Wolf said, we absolutely do not want to get into the minutiae of how Brunel operate their business. We want to focus on investment performance, and I think if we shackle them too much, then to be blunt, we give them an excuse to say, the reason why our investment performance is not hitting the targets that we require is because you've prevented us from doing X, Y, and Z. So I think we need to be a bit careful in terms of, like I say, we've set this thing up. We need to let them operate. I think Councillor Brown also mentioned, what ultimately can we do about this? And in the shareholders forum, there were some strong words from. Almost echoed the conversations that the oversight board had between the shareholders. There were some very strong words about those funds that are potentially a block to us, we're now getting the tools that they need to deliver the performance that we need. And ultimately, it could come to a situation where if there are shareholder funds that feel so strongly that they cannot support this, then the other shareholders may need to question whether they continue within the pool. So some very, very, very strong opinions on it. A more medium-term thing that can be done is to look at those items that require 100% approval by the shareholders, and there's a lower benchmark for other matters where it's it needs to be 75%, which in effect means 8 of the 10 shareholders need to approve it, so that we've got the balance right in terms of things that need unanimous support are fundamental to the partnership, and that there aren't things that perhaps, you know, that lower threshold could be a better threshold to hit.
So, Chairman, could I just respond directly to what Councillor Brown has said? And just for the avoidance of doubt, the benchmarking aspect of this is only one of the mechanisms, obviously, for getting to, if you like, a pay strategy for senior executives of Brunel. There are plenty of other factors involved as well, but it is, I suppose, difficult with a quasi-public body to bridge that gap between the private sector and what local government would normally expect to do. And that transition has been difficult for some people to completely get on board with and to understand. Having said that, I think that it's been pretty well managed by Brunel. We've always hit the sort of ceiling of what has been allowed, because what's been allowed hasn't been as high as it needs to be in the marketplace. And that's always going to be a dilemma, because then comparisons are made to the pay of chief executives of the authorities or the Prime Minister's salary or whatever other comparator. And I think there's a real will to move away from that approach and to make this a more sustainable position in a framework that's going to work in the longer term. And so benchmarking is clearly part of that, but we're not allowing the other pools to set the parameters for us. I think it's just another point of reference that's needed when we get to that point. The only other thing I didn't mention, actually, Chairman, was that obviously at the AGM, that is the opportunity for some of the non-executive directors to be reappointed and for the chair to be reappointed, and they all were, albeit not unanimously in one of those cases.
Okay, thank you. Any other further questions from anybody? In which case, I think, John, you could be rest assured that we're all completely behind the position that you're taking and everybody else is taking, and that we do want to make sure that things move ahead as swiftly as possible and with as little disruption as possible. And let's keep our fingers crossed and everything else crossed that this will get sorted in the very near future. Thank you very much for that.
Thank you very much, Chairman. If we hit unexpected choppy water in between, obviously Aidan, David, myself, in the first instance, will come back to you and the Vice Chairman just to report in, if you like. Yeah. But thank you for that endorsement. It makes a big difference, actually, to our confidence when we're doing this work outside of Dorset.
Good. Thank you very much. Okay. Moving then on to where are we? Item 8, the independent. No, sorry, 9. Sorry, item 9. So the independent review by Peter Scales. And I have to say, for those of you who missed just saying before the meeting started, Peter, it's our last meeting with Peter. Thank you.
My last meeting with you, yes.
And well, thank you for the huge amount of work you've done for us over the years. And yeah, I hope you have a very good retirement.
Well, I'm not sure I've actually had to do a lot to help you, because you've been doing well. But I was going to ask if you'd indulge me for a moment to go back to 2009 when I was first appointed. And I think my report was 16 pages. We were dealing with guidance that had been introduced the autumn before, and we were setting up what was then the government's compliance statement. And that guidance is still valid today. and it's still being used. It's been adjusted, but it's still being used, and that's 14 years old now, which is quite surprising. Two of the architects of that guidance, two civil servants, have both retired now. And at the time I was appointed, they said to me, well, they congratulated me for being appointed by what they said was one of the best run pension funds at the time. And of course, at that time, we were talking about the good governance of pension funds. And that encouraged me, that they thought Dorset was a good example. And I don't know whether you're the best or one of the betters now. I don't have access to all the information, but you are still well run. And I think that's an endorsement of the committee. And I have to say, two of the members of this committee today were, of course, members of that committee in 2009. I can't remember if they're actually at that meeting when I first came, but Councillor Beasley and Councillor Legg were both members then. So that also demonstrates some continuity in this committee.
Do you want to tell us which two? Because I've forgotten.
Councillor Beasley and Councillor Legg. There may be others, but those two I remember.
Howard's not done it continuously though, but
No, I had a break, but that was just a refresh.
Anyway, I mean, that brings me to the point, which is having gone through the board papers and so forth over the past year, my conclusion is that you're still being governed well, and I think that's good. I've also looked through the annual report. I'm sorry, my report's on page 130. I'm going through. I've looked through the annual report. The annual report is still, in my view, a good representation of what's going on. It's a long report for the obvious reason. It has all the policy papers. And I understand that there are moves to take that away from the annual reporting process now. And whether that ever comes, I don't know. But that would concentrate more on actual performance against policy rather than repeating the policy. In paragraph 5, I've referred then, and most of my report really is about things that are coming and things that concern me that I'm leaving you to deal with. I'm afraid that there's some of the issues of change in governance. And in the top of page 131, paragraph 5.2, I just refer there to the benefit to this committee of Councillor Beasley, and that's been demonstrated well, I think, at this committee, the way in which he's been able to give you that insight into what's going on. And I've referred to a number of issues. Some of these are covered in the Pensions Administration report. None of them will be new to you. Councillor Beasley referred to the pooling arrangements, and I think there will be more guidance, but we have whether any regulation for funds to pool money is only ever to report on their approach to pooling, and pooling was done on the basis of guidance from the department, and that guidance itself is now 7 years old, and clearly it's not working as it might have done, and the whole thing has been based on the threat of direction rather than positive direction, positive regulation guidance. So one of my concerns is that that balance may change, and I've just mentioned there's some of the things that I would be concerned about. And I think, well, climate risk disclosure, that's come up. All of these are areas where the fund is being asked to report more and more on details, and then possibly being charged with breach or non-compliance, when some of these issues are quite difficult to deal with. Pensions dashboard has been dealt with in Karen's report. I mean, that's now been delayed yet again. And I think, to me, that evidence is the fact that we're diving into changes and new things and not being properly prepared. And I don't mean the fund, I mean the government is not properly prepared. The Scheme Advisory Board has done a lot of work on this, but it can't actually break that Gordian knot to get the civil servants to do something. I mentioned about the for Pensions panel, and I was particularly pleased that the Scheme Advisory Board have now decided that guidance should be issued free of charge. That's always been a bone of contention to me, that SITFA could prepare the guidance and then charge for it. So I'm hoping that will work out that way when it works its way through the processes. And then on page 133, paragraph 6, I've just referred there to the pensions regulator and the infamous single code of practice, which is still not available. And I've just put in there a couple of quotes from pensions regulator they made at a very recent conference, which tend to frustrate me even more, the fact that there's going to be more guidance coming to you. We still don't know exactly how that's going to apply to the LGPS. They're trying to treat all pension funds alike when they're not, clearly not. And my underlying concern there is that the regulator is trying to get involved in the investment and funding of the LGPS, which is not allowed to do at the moment. And there's another regulatory oversight. And I've also touched there on the annual survey, which is attached to Karen's report, which I find rather simplistic as a survey, and I think their conclusions sometimes about is really not about how a pension fund is being governed. So in paragraph 7, I've just listed some conclusions similar in the way that I've done previously. I always ask myself the question with these changes is, are they going to benefit the members of the scheme, or are they just for the purposes of somebody else who sits at a desk and writes regulations and ideas? So that always concerns me. And I've left you with a throwaway line of good governance is under threat from good governance intentions. And if I need to explain that, I think it's that we have good governance in the local government scheme, but I think there's too many people interfering with it. And that's a complete distraction for the people trying to do the work. And I think there's a real threat, particularly on the administration side, of it becoming so complicated that, you know, it almost making us fail in some areas. So that's a genuine concern of mine going forward. But I'm sure we will all deal with it, and you will deal with it at Dorset. So thank you. Any questions, of course? Sure.
Yeah, my thanks for the time you've been here. Under your conclusions, you say you effectively you say in the end, good governance is under threat from good governance intentions. I get that, but you say there does appear to be at times not a clear objective that change should benefit scheme employers and members, other than implicit expectation of improved governance. I take that as absolutely justified comment on our performance. So my question to you is, what do you suggest we do about it to get over that? Because I think you're right, and I think we employ people like you to stick us in the ribs now and again and say you could do better at this, because that's what your job is. But what I'd like to see is what you expect us to do to move away from what you've just talked about.
Well, I mean, it's difficult to pick on one particular area as an example, but I think the way in which the committee operates, it is operating for the benefit of its scheme members. As representatives, it has its local pension board. If I could use a sensitive example, perhaps climate change. When this committee considers climate change, it is considering climate change in the context of how it impacts on the fund's performance, rather than, I hope, being more concerned about climate change as an issue. And I think that's quite a difficult and sensitive area to get the right balance. I think the committee has been doing that rightly. And in my view, I mean, for scheme members, it has no bearing because their pension is guaranteed in law. So there's not an issue for fund performance. It affects employers because they have to pay the contribution rates. So it does impact on them. But it's a very, very difficult balance. And I think this committee has drawn that very well. I mean, you have members of the public in, you deal with their comments, and I think that's quite a fair way to deal with it. But that's an area where I think there's too many people imposing things on you that are very difficult to deal with. Climate change reporting will be extraordinarily difficult. Pensions dashboard, I mean, it's so complicated. It's almost designed to fail.
Well, I'm completely in agreement with you that we, as a committee, should remember that our first duty is to the scheme members, and not to either political viewpoints or niceties and nuances of governance. Much of that is to be applauded. So I'm completely with you, and I'm wanting to reinforce that message. But we must, I think, remind ourselves at every single meeting. That's what we're here for, scheme members.
And the people who elected you, I should say as well.
But no, I think elected representatives on this committee are not representing their own wards. They're acting in the interest of Dorset as a whole. I feel quite strongly about that as well.
No, sorry, I meant council tax.
Oh yeah, fine.
Yes,
fine.
it's
Yeah,
the ultimate backstop is the
Yeah.
taxpayer themselves.
Yeah,
isn't it?
absolutely.
That's the democratic accountability that's so important.
Any questions? David, I think you wanted to remind about what happened next in terms of Peter's replacement.
Yeah, excuse me. Thank you, Chairman. Thank you, Peter. So I think replacing Peter with a like would be quite challenging. It's a very niche role, I would say, that's been done incredibly well. But Peter's retirement does coincide with something else that's happening, if you like, on the governance side of things, which is that we're in the process of appointing independent chairman of the local pension board. I'm not sure if we've actually got to the point where we've gone public with the results of that, but it's imminent, and we think as officers that it would be a good time to take stock once that independent chairman of the local pension board is appointed, for officers in conjunction with the new independent chairman of the local pension board, in conjunction with the chairman and potentially the vice chairman as well of this pension fund committee, to try and identify what gaps it is that we need filling from someone, to, if indeed there are any gaps that need filling, from someone external, and then look to try and plug those gaps rather than just looking at what Peter's done for us over the many years today and going straight out to try and replicate that. So obviously we can continue to feed back to probably to the next committee in terms of where we've got to with that process.
I mean, certainly I've said before that irrespective of why people are leaving, whether it's because of retirement or any other factors, we must on a regular basis review our relationships with outside consultants and make sure we're getting the right services and paying for the right contracts and doing the right things. And this would need to be done regardless of what Peter's doing, but it does give us an opportune moment, along with the appointment of the independent chair of the pension board, to actually assess where we are and see what's the best way forward as cost effectively as possible.
Yeah.
Anybody else, Peter? In which case, thank you very much, Peter.
Okay.
And we have a jolly good retirement.
Well, I've enjoyed my time here.
Right, on to item 10. It's Karen, over to you for your administration report.
Is to appendices this month, starting off with the that have added in a column of 5. And I'll talk about that again a bit more. We've also changed how we record. When we look at what we do for members particularly like to be able to talk to somebody whose scheme is very complex, and they struggle to understand their pension, and as a result of that can often take risks with their pension. So we're very proud of the fact that we offer a good service, and we know that we've got a new system. It's functionality and capability is much advanced. We have now introduced a system where we can accurately record the calls and the nature of those calls, so that hopefully we can understand where we can be a bit more. So that's all quite important. In terms of the KPIs, you'll see that there's still a couple of areas, and they are important areas. Just to give you some context to that so that you can understand a little bit of the background. You see the journey time problem there. It's quite low, and I think what that suggests is that when you look at the detail, and the detail is immense. There's a huge amount of detail in the reports that I receive from the system and from the every month. A lot of the work is processed very quickly. Some of it struggles to get through as quick. Now that could be for a whole variety of reasons. It could be to do with complexity, and it might need a specialist person. It could be a whole range of things. One of the main things I'd like to point out to you is that we have got some new staff, really good staff, and we are really, really pleased. And I think that worked very well, and it will suit us and fit us well for the future and the challenges we've got, particularly with McLeod really is the biggest challenge we are going to face. What having new staff doesn't do, unfortunately, is bring us experience and expertise. And where we have a bit of a bottleneck is we are now in a really good position with the work, where we're able to pass out the urgent work very quickly, and it's done very quickly. Unfortunately, we have a shortage of people at the higher level to check the more complex areas of benefits, and that is having an impact. And there's no quick fix to that, because for some areas there's a huge amount of complexity, and people need to be experienced possibly for years before they take that on. However, when I did look at this a little bit more, there's obviously much more to the story than that. Some things can happen sideways, key staff being on, for example. I've also picked up, we've also established that the reporting mechanism of some of these cases is really, really complex. So the process maps, which is the structure of case management within the system, is huge. And we have identified that where a case has been done and the employer has to be contacted because there's a discrepancy or a concern or an issue or a question, that if that's done at certain times within the process, the clock wasn't being stopped. So if you imagine that you've got a period of time from beginning to end, and during that period of time, you might be waiting for a member to come back to you with their forms, you might be waiting for an employer to provide information. The clock that times the length of the journey of this task has to stop. But we've realised that depending on where it starts within the process, it's being missed. So some of those cases, it actually was that we were waiting for an employer to come back to us, but that has been rectified. So I think there's, as always, there's a mixture of things there, but I was really actually very pleased to hear how quickly now we're able to pass out the urgent work, and we are now starting jobs that include during the time of our system change and the subsequent loss of experienced staff. So we're actually in a really, really good position. Even though it looks like there's a concern there are things to be concerned about, but we're actually in the best position we've been in since before we changed our system. So before we move on, has anybody got any questions on that particular aspect?
Yeah. We had a discussion which I think ranged enormously. I think it was 2 committees ago, and then probably a little further than we should have done. But we mentioned at the time about education of existing staff and bringing them on. Is that something which we're continuing to look into? And
yes, I mean, you just don't stop learning in this job. You know,
yes.
You never reach a point where you think, actually, I know everything. It just never stops.
Yes.
So staff are developed in the area. Some staff find certain areas of the work a bit too challenging for them, which is fine. So we have a team with a huge mix of aptitudes, if you like, and abilities within that. And some people don't always want the higher level of responsibility. That's
yes.
a problem that we have encountered. There's a lot of stress that comes with certain areas of the work, particularly dealing with the public,
yes.
and particularly dealing with sensitive issues. Finance is a sensitive issue, the death benefits. It can be a little bit stressful. So the staff, I have to say, we're a happy team and they're well supported and well trained. So I feel confident that it will come together now that we've got more resourcing. And I hope, although the McLeod regulations will come in this year and will enforce this year, I'm hoping that get even the new staff to a point that they'll be able to contribute, if not to all of that work, to some of it, which is really good.
Of course, that'll be a drag on every single pension fund up and down the entire country when everyone has to deal with it all at the same time.
It will be chaos everywhere. In actual fact, for the LGPS, the impact from the cloud is not as huge as some of the other public sector schemes. But having said that, the difficulty is you have to revisit everything you have done. So even though the proportion of benefits that will end up changing are small percentage terms, you have to look at 100% of them. And that's the difficulty. And that will range from the straightforward to the really complex. The one particular complex area is death benefits. So the death benefit, the ill health benefits under the old scheme were very, very different in how they were calculated, as were some elements of some death benefits. So that's only going to be able to be tackled by somebody with a lot of knowledge.
Yes.
But there will be some areas that it will be much more straightforward. Hard to automate is my own view. It's complicated. One issue, obviously, with McKenna, making sure that our data is right, and data is very, very good, but it does rely on what the employer tells us, and that is a little bit more of an unknown. Have the employers been able to give us all the data that they should have done? Is another question. We've got some cloud guidance now of how to deal with data that's missing. So we may have outsourced payroll providers disappear. Some employers don't keep that data for very long. Some employers disappear. So it's quite hard, and some employers have struggled to get out some of the information that we need. So we've got some guidance on how to deal with that. We're trying to push it back to employers to say, you know, the default for you will be higher liabilities. It's in your interest,
yes,
to make sure you give us everything that we need to get this right going forward.
Accurately and properly.
Yeah. It is difficult for them, and some are much more engaged than others. Recent meeting, we've changed how we do. We asked who would like to come. Now we invite everybody. So we're having a bigger attendance at our regular employee meetings, and the cloud and the data requirements is discussed, and that message is reinforced that you need to think about the liabilities here.
Yeah. Thank you very much.
Councillor Roberts, I think, welcome to the meeting. You've got your hand up. You want to ask a counter question?
Yes, good morning, Chairman, and apologies for joining just a bit after the start. I had to chair another meeting this morning. Karen, I wanted to just touch on the KPIs. There's two there that look a little worrying. I wondered if you'd like to comment on the two in the 40s and what effect that's having on recipients of pensions, or just really your comments on those two. The rest look as though everything's quite well under control.
Yes, I think that the big one for me always is the ones that impact members, and you'll see that you're looking at retirement quotes there, and that is actually a concern, because that will impact members. But this is where we particularly struggle, because we don't have the number of experienced staff. We've got staff now that are processing things, but we don't have enough experience at the high level. That's improving all the time. This was also the area where we identified that there was an issue with the clock not being stopped, where there was an employer query going on. So how much of an impact that will be, we will have to see. But this is where the team are focusing. I think the overall journey time wasn't too bad, although, you know, we're obviously not where we should be. The overall journey time wasn't too bad, with a couple of outliers. So that sort of meant that there was a small percentage of quite stark cases where there were issues. So those issues may lie with data, with complexity, or with, you know, the member disputing the benefits, that sort of thing. The other one that is low there is the transfers out actual. And that doesn't impact the member so much, or the fund so much. So that's possibly why other areas there are being more focused on. I think where members are most concerned with when it comes to transfers, some of them have a guarantee period, some don't. But certainly members do like their transfers in to be completed quite quickly. They'll be on the case there. So transfers was a big area that was impacted by the systems change, but we're really getting there. So these are all being closely looked at by the team, who are all very aware. And I really do think that we will just continue. We've seen some improvements since the last report, and I think that will continue, and I'm confident it will. Does that help?
Yeah, yes, that's exactly what I was hoping, that, you know, the explanation. So thank you very much.
Thank you.
Thank you. Any other questions, David?
Yeah, just on that KPI report as well. Actually, I like the additional column about average working time. Just to clarify, that's number of days from when the case came into when it's on average when it's completed. Is that right? Because it doesn't sort of say what unit that average working time is, just to sort of clarify that.
That's in days, and now that days may not be from when it first appears on an doorstep to when it goes out the door. That may be, for example, with retirements and transfers, there's a lot of going back and forth between companies, members, employers. So it's from the date on which we have everything we need to see, because that's the sort of disclosure regulations will say the date at which you can proceed. So, for example, we cannot begin to calculate retirement if we don't have what we need to calculate it. So, but other things are much more straightforward. You'll see admissions. Those are dealt with largely by an automated process. So and on bulk. So that's a lot easier. What isn't dealt with in bulk, which is also very good, is the correspondence. And we have a very strong admin team who deal with correspondence. So that might be informing us of the simple changes or making inquiries. But there's always a lot of that and a lot of work that goes into that, and that is always dealt with quite quickly. If it's a more complicated matter, obviously it gets passed to the technical team, who may have to deal with a technical inquiry.
Thank you. Councillor Wall?
Yeah, just sorry, this is a slightly bizarre question, but I may have missed it. We've got Gary Suttle's name as the responsible officer on the report. And I'm not sure that his name has been on reports before. And as the finance portfolio holder, if there is a question of political implication, he should either be here to answer it, or he should have deputed somebody else to answer it on his behalf. And I don't think either of those is true. Yeah, you agree with me?
Yeah, I do agree with you.
I don't think Gary's name was there. It really leapt out at me. And he's never attended the pensions committee. And I think it's a bit unfair to put a cabinet member's name against a report that I would wager he hasn't seen.
Yeah, I'm having a look to see as to why that name is there.
Yeah. I mean, you know, we have a rule that says if a report comes out with a cabinet member's name on it, they get to see it before it comes out. And I'm sure the same is the BC. So you need to check that.
I think it's probably just having it automatically.
Yes. Well,
somewhere down the line.
Can we not have automatic?
Yes. Yes. Because he has no responsibility from there.
No, absolutely not.
So, Councillor Roberts.
Yeah, I was just wondering whether there should be a cabinet member, as it's a joint committee.
Yeah, no, absolutely shouldn't.
No, it shouldn't be.
And I think that this is probably not appropriate to have one of our cabinet members on here.
Yeah, I think we're all in agreement on that. I think there's an error crept in somewhere.
Yeah,
and we'll just get it sorted out.
Thank you.
Yes.
That's a bit okay. Is there any more questions on the PPO?
Yeah.
Before I ask you a question, I will make a few comments. I've listened quite a lot to Councillor Peter Wolf this morning, and I agree wholeheartedly with everything that he said. It does occur to me, before I ask a question about allowances, etc., it does occur to me, even on page 1, where we have our membership, it doesn't actually indicate to the viewer, to the reader, who individual members of this committee are and who they represent. then I do think that would be useful on page 1. My question about allowances is how much time is devoted to working out the whole question of lifetime and annual allowances and any difficulties arising. Hopefully that problem will diminish for many employees tomorrow, but we can't necessarily foresee the Chancellor is going. But how much time is spent working on problems of people exceeding lifetime allowances?
Lifetime allowance, we don't have many people exceeding the lifetime allowance, probably as they'll guess as a whole. A lot of the changes that were likely to happen in the budget tomorrow come as a result of the NHS pension scheme being, very strongly
I understand the
speaking out
topicality
in terms
of it.
of their difficulties that they've experienced. The difficulty is with the lifetime allowance and the annual allowance, so proportionately the amount of people who spend working on it is effective members, because it's very. So if you have a retirement where there's a breach of the lifetime allowance, that retirement will have to be dealt with by specialist staff, and it will take a lot longer. But we have very few people exceeding the lifetime allowance.
When it occurs, it's problematic. Thank you for putting that on record. Thank you ever so much.
Any other questions? No, Ms. Karen, do you want to carry on?
So carry on, yeah?
Yes, please.
Yeah. Okay, put in there about the consultation change and revaluation date. This again has stemmed from the NHS and the issues that they're experiencing with their scheme and tax charges. And that basically is NHS is struggling to have consultants and experienced doctors return to the workplace because of the tax charges. So there was a very short consultation. The difficulty with this is that the natural fact the consultation has gone through and we've had confirmation that these regulations will now be in place and they will take effect from the 31st of March 2023. Now, this change in the revaluation date is something that won't impact members that they will see, and it's been backdated. So the revaluation is the indexation, if you like, that's applied to existing care accounts. The revaluation will not apply to people that are retired or deferred members. So this impacts active members, and this is the amount that their care account pension will increase for otherwise, because 1 year is negative inflation each year. Because of the high inflation rate, CPI is 10.1%, that's going to have the impact of meaning that more people are subject to annual allowance tax charges. And it was looked at and deemed to be unfair. Why it's not been addressed before, I don't know, but I think obviously the low and more stable interest rates have meant we've not had this huge impact before. So basically what the government have done, rushed through changing regulations to prevent sort of an excess number of people getting annual tax charges. For us, this means that further complexity, all system providers for LGPS administrators cannot get this changed in time. So there will be retrospective changes to benefits. And the biggest impact will probably be in terms of calculating the annual allowance. However, if the limits then increase as they are suggested in the budget, then less people will be. So just to confirm that that's going on, in some ways that's a technical matter, shifting the date from the 1st to the 6th of April so that it's encompassed in the pension input period, but actually it's then applied back to the 1st of April. So members themselves won't see any impact unless they are impacted by the annual allowance. It's a benefit. So just to let you know that's going on, that is a lot of work. The next item is the dashboard programme, and I had said previously.
Can I ask a question on?
Yes, of course.
You mentioned in here that the 2 weeks for consultation was inadequate and you couldn't do it. Can you give me an idea roughly all the people, all the organisations that entitled to be consulted, how many did manage to respond?
I don't know whether it's just come out, the consultation results have come out, and I've not looked at them in detail, but I think you can usually say how many people responded. So that information should be at that link. Actually, it's a bit new. It's come out. It's come out since I've written this report, but I can confirm that link in the next report. You can have a look. But they will tell you how many people responded. I think, yeah.
No, it just strikes me, you consult, but you don't get any response, and the value of the consultation is zero.
Then usually a consultation will be 12 weeks, so it's really, really unusual. I think it was one of those things that we knew it would happen regardless, and that may have people. But the LGA always respond, and their response is available. So, and they represent all funds, and their sort of view and understanding is excellent, and it comes from our perspective as well.
Thank you, Jim.
The next item to cover is the dashboard, which is already mentioned. I was going to keep this as a regular feature on the admin report, but DWP have put that at the introduction. So I probably won't. I will come back to it when things are moving in time scales. I think the technical and security challenges for this in developing the infrastructure was just far more than they anticipated, and it has just been too difficult. Lots of work has been done on this by our software company people, but they have stressed their commitment to the programme, but we're looking at quite a sizable delay. So I won't keep this on in a regular feature unless there is something tangible that needs to come on. What will be kept on is the cloud, because that will be coming through this year. We have just had regulations confirmed of how to treat employers, as we've mentioned, and haven't provided enough or accurate or any data. We've had regulations, different consultations on to treat tax aspect of this, lifetime allowance, allowance, looking at retrospective benefits. We have appointed Aon via a national framework to provide project guidance and support in setting up our own project internally. So this will be a real help to us because the officers that we have are under enormous pressure. So this will be a huge help to them. Has anybody got any questions on the cloud? I think at some point I will probably, when the regulations come out, do a bit more of an in-depth look at the cloud and you know, the impact to the administration service and the impact to members. Because I tend to do sort of short information sessions for the board about the administration, and I can let people know so that if you're interested, you can come and find out exactly what it means. But we will obviously be issuing new week reports and stats as time goes on. I think the work that he's doing will be over years. It will be a substantial thing. The consultation of the cost control mechanism, I think that comes up quite regularly. The important thing here is that the consultation, you'll see the summary at 6.4 there, but scheme-wide valuations. Now, these types of valuations in LGPS, this is all about the member benefits. So the valuation that we do every 3 years, and we have just had, looks at the valuation of the Dorset Fund and sets the employer contribution rates. These national valuations look at all funds, and what they do is they look at the structure of benefits. So what they have the power to do, or the possible impact, will be a change in benefit structure. So that could be a change in contribution rates, for example. It could be a change in benefits. So these are very important, and this was brought in with the Public Sector Pension Act. It sort of quickly went a little bit wrong because of McLeod. I think it was too prescriptive. So basically, you know, my thoughts are what they've done. They said, actually, we need to be more flexible. We need to be able to take into account things that might be going on. And obviously, McLeod is the big example. So in many ways, it's good that they are getting to a point where that valuation, the cost control mechanism, as it's called, is settling down and will be better going forward. Any questions on that before I move on to the next one? Everybody okay on that? I've just confirmed the new ministerial appointments, on which there are many, but there are a couple of key ones there. The overseas existence checks.
Sorry, can I just have, we have monthly meetings with the Dorset MPs, Dorset Council, and I know that BCP leadership have regular meetings with the MPs. If there is something you would like us to ask our MPs to ask ministers, you need to let me know, because it is quite a useful mechanism, because we've got Richard Drax poking in the door to go to ask him questions about the levelling up, which is primarily just for Dorset Council. But in this case, I'm happy to ask it on behalf of this committee, but you need to tell me which minister and what it is. And then what we do is at the meeting with the MPs, we nominate one MP to actually go and talk to that minister to ask him the question. It has proved quite useful. So, you know, don't forget that as an option. Sometimes they tell us to go away. Even that's useful in itself, because it tells us what they don't think is actually important. So
that could be useful. I think that one of the difficulties that the LGPS has had in the past few years has been that regulations haven't been changed as they should have been. So there's an awful lot of stuff that has been parked and put on the shelf waiting for, I think, you know, we had Brexit, we had a pandemic, we had all sorts of things. So there's a lot of things, and I have raised things myself with Dina, but that might be useful. The simple things like the forfeiture regulations are not fit for purpose.
Yeah, we talk to the MPs. I don't know what Graham at BCP does. Matt talks to the permanent secretary at DLUC fairly regularly in his president of Solace role. You know, we should use our connections if we want to achieve something. Now, I don't want to do it on my own, so I'm very keen that if there is something that BCP thinks important, that we agree it together, and we should agree it at these meetings. But let's use the connections we've got, because we've managed to get some quite good progress on some issues, and for interest, we managed to make negative progress on council home second tax, which most of our MPs are against. But I don't want to get into that. No.
Isn't the place really?
No, absolutely.
Karen, please.
Okay, thank you. A slight update on the overseas existence checks. You'll know that we have very good national systems in place for our priority checks and UK-based pensioners, but that's not possible for our pensioners that we pay that live overseas. This project is coming to an end now, and I think about 400 odd members, 38 have not responded. So what that means is about 38 pensions will be suspended. And what happened the last time we did this was that when you stop the payment, people then magically get in touch. They may have moved, they may be unwell, something like that. But it's the stopping of the pension that means that they suddenly sit up and take notice. And then what I'll be able to do at the next meeting is report how many pensions have been suspended. But nothing has happened. The last time we did this, 9 pensions remain suspended, so we can assume from that those 9 members were deceased. That's what we assume on that basis. It's really frustrating not having confirmation of that, but it's really difficult to trace people and find out what's going on in their overseas.
But clearly, if they're not responding to the money stopping, they almost certainly have passed away.
That's what we assume, and you know, it's nice to know, because sometimes people don't realise there might be a spouse's benefit payable, for example, sometimes a death grant, but unless somebody gets in touch with us, we're really limited. But I think last time there was a large pension in France and we couldn't get any. The danger, of course, is that there is fraud, because you don't know how long somebody has been deceased for. But we're limited to what we can do. So this was last done 5 years ago. 5 years was too long a gap, but the pandemic made it difficult to do the process. So we'll probably repeat this, I should think, every 3 years. I've attached, as you can see as well, the Pension Regulators Governance Administration Survey. I find that a useful report to have each year. That is a check of some of the basics of governance that need to be done. And I think that's about it, other than to confirm that we have had interviews and made an appointment to an independent chair. And that is Richard Bates, who know. So we have a really good applicant, I have to say, very good. And for me, it will be a huge relief, I think, because a lot of work falls to me that really I need somebody independent to do the governance work. That's quite important. With everything coming along, good governance, etc., and that sort of thing, is really valuable. So hopefully, Richard will be able to start that role.
Anything else?
Can I go back to this pensioners living abroad and tracking them, tracing them? If I understand it, when somebody dies, their bank accounts get frozen. And in such a circumstance, would you not get a bounce back of any contribution?
Yes, and often we do. But that that happens really commonly in the UK. There's a really good system, but these people are in all sorts of different countries. But even with that bank account, it would rely on someone closing that account. And if you think of the situation of a married couple, for example, if there's a joint account, that account may remain active but change the name. So in most cases, it is quite simple. The payment is returned, but that doesn't always happen, as you can see. It depends what country it is and what the circumstances are. That's the concern.
In this country, we get returned, I'm sure.
It's really, really efficient in this country. I mean, everybody has to register a death. And from that registration, we can do mortality checks that are done every month. So we are informed, and we've got Talis ones now as well. So we tend to be informed pretty quickly of any deaths in that are UK based. It's the rest of the world that is different. Yeah.
Okay.
A bit more of a challenge.
I mean, some societies are not bound to the rule of law as we are, and it may well be that some degree of criminality goes on, and people would know they can just keep them out themselves. But that's why we do this, the check, because it is the only way to find out. Because people won't respond to a letter, and you've got no choice but to suspend the payments and then see what happens.
I do it almost every year.
Yeah, I think what we'll do this year is we'll look at how much it cost us, because it's not cheap, and as opposed to how much we're saving. We'll do that for the last time as well, because it's important. It does guard against fraud. It does protect the fund.
Okay, well, thank you very much for that, Karen. Informative as ever. On to our many other external advisors. Steve, tell us what you think about the state of the world at the moment.
Yes, I'm conscious of chair. Could I just ask for a comfort break, please?
Yes. Okay. Yeah. Yes. A 5-minute break. Yeah, a 5-minute break. Right, we'll carry on to Steve's report.
Okay, this is Steve Dyson. I'm going to talk about the economy and markets, and then about the performance of the fund overall. So just a few pointers on what's going on in economies. Inflation looks like inflation is in the process of peaking. It's in wholesale gas prices. In the UK, well, there's one forecaster that says it may fall as low as 2% by the year end, which I remember Councillor Wharf said 9 months ago. There might be a kind of decline to around 2%, but now there are some official economists saying that. But the key thing is the level at which it settles. And there's always, it won't, of course, settle and stick around one level of 2% or 3% or 4%. There'll be waves. And in fact, I've seen a couple of economists arguing about the comparison with the 1970s, where you had a decline and then you had a second wave. And it was the second wave which was more problematic for the markets than the first wave. We don't know, but the key thing is at what level. As far as the economy is concerned, in the UK, we've sort of narrowly technically avoided recession, but recession is still a major risk for the UK economy and all global economies. The UK, of course, itself is struggling with long-term slow growth issues and productivity issues, which are well aired at the moment. And obviously, we have government trying to do something about that, and there are many underlying causes and underlying issues. As far as interest rates, the Fed and the bank have been raising rates very sharply, the sharpest rise in interest rates in decades that we've seen. They still have further to raise. What may be relevant is this situation that's emerged over the last weekend about the Silicon Valley Bank. That actually, in 1984, I think Brunel mentioned earlier on, there was at the time of the Continental Illinois bankruptcy, that was a significant reason why Paul Volcker, who was then the chairman of the Fed, held off with further interest rate rises at a time when they would have perhaps otherwise been raising interest rates. Interest rate markets have softened a little bit in the past few days in response to that situation. So we'll have to see how that plays out. It may mean that the peak in interest rates is not quite as high as we thought it was going to be. We will see. Equities rose in Q4. Value stocks performed better. There's been some improvement in non-US equities. If you recall, over the past few years, US equities have been the driving force of world markets. Well, there's been some improvement in non-US equities. Until the past few days, European equities have been doing better. UK equities have been performing a little bit better. The challenge for equities and companies is that with this softer economic environment, profit margins are clearly going to be under a lot of pressure this year again. So there will be, we're in for a period of weak corporate profits. Bonds and corporate bonds. Corporate bonds are looking better value than they have been for many years because, of course, interest rates have risen. So that means the yield on those bonds, where there's a spread over the government bonds, are looking more attractive. And as you will be reminded later on, we've been buying some of the corporate bond fund, the Brunel Corporate Bond Fund, over the winter period as we've taken money out of other asset classes, which again will be reported on a little bit later on. Now, corporate bonds are also subject, companies are obviously also subject to the same issues that affect equity stocks, i.e. corporate profits. So the markets are trying to get their head around how many corporate defaults there will be in the corporate bond market. But some increase in defaults is already priced into the corporate bond market overall. Very importantly, we're coming up to the strategy review, which is going to be conducted over the next 3 months, I think in time, hopefully for the June committee meeting. And I think there's potentially a training day in May, is my understanding, that where that will be discussed. The strategy, it won't be easy. We've got to achieve our 4.9% discount rate. Target allocations are likely to change, but that's something that I anticipate spending quite a lot of time with the officers and with the committee working on that strategy review and the proposals that are put to us by the investment consultant. Fund performance in 2022 down 10.2% versus down 4.4%. So not good performance in 2022. In Q4, performance overall was up 0.9% versus up 1.9% for the benchmark. So again, behind the benchmark. Now, the headline numbers look bad, and I would summarize this as saying that there are two factors behind the fund performance that you need to, two big picture things you need to bear in mind. One was the poor performance of Brunel in the first half of calendar 2022. And then in my report, one of the things I talk about is how in Q4, there's a technical issue, which is the difference in timing between the valuation of the private market assets like property or like private equity or like infrastructure and their comparable benchmarks. So in this report, in the State Street report and in the Brunel report, that timing hasn't been dealt with, cannot be dealt with. And it manifests itself most notably in property, where we still have 260 million of property assets. And our property assets are valued at the end of December the 31st, when the property market is finally beginning to decline in Q4. But the benchmarks are from the end of September, before the sort of latest decline. So we've got an issue really in the way that our statistics appear for us, in that it's not what I would describe as an apples to apples comparison. Now, all of that will eventually come out in the wash, but it just means that there's some noise in the statistics, in the performance statistics at the moment. So those are most of my kind of main points. I know we're trying to catch up with time a little bit. I'll just say a couple of things about Silicon Valley Bank, which is this thing that's happened in the past few days. I think there are a couple of lessons from that, which is that what happened. This is kind of what happens when the tide goes out. We've been in a very long period of low interest rates, and a lot of people got very used to very low interest rate, long-term interest rates, and then suddenly there's been a change in the past 18 months, and you then see that some in pockets of activity around the global economy, some foolish things have been happening. I mean, this should have been caught by the regulators in the case of Silicon Valley Bank, where the bank has got mismatched assets and liabilities, and you're not supposed to do that as a bank. So I don't quite know how it has happened, but it has happened. So it's a kind of, but to me, it's symptomatic of a long period of low interest rates and then suddenly a change. And it might also be partly symptomatic of the other thing that I was thinking about was there's been a very strong period for technology. So technology, and so that obviously is lending to to small technology companies at bank, and so that's another area that has changed. Technology stocks have started to underperform in the past 18 months, and so that's caught people unawares as well. So it's still a kind of very live story. Fortunately, it's been contained by the regulators, by the central banks have acted. HSB has stepped in for the UK, the UK branch of Silicon Valley Bank, and likewise in the US, the regulators are propping up Silicon Valley Bank and another bank called Signature Bank. But it's caused quite a lot of weakness in bank stocks over the past few days. I was quite reassured by actually one of the things that Brunel said, which was that it hasn't affected our performance unduly. But I do observe that one of their managers had a holding in what was a high-risk small bank. It might have been a tiny percentage. I think we said it was 0.6% or something. But it doesn't. I don't think it reflects well, personally. So I'm happy to take questions on any aspect of the fund.
Yeah, the problem that many markets have at this point now is to think it's not that they've gone bust; it's that there might be others who are teaching on the edge who we just don't know about. And they get caught out. And 2008 happened first. I think Bear Stearns went bust, and then Lehman's went bust a year later or whatever. And there was an uncertainty about whether that was the end of the process or whether it'd be just go on for quite a long time, operating in a very difficult market.
Yeah, I mean, you can never tell with these things how they're going to play out at this point. Who's still to be exposed. I mean, ultimately, the authorities step in and bail out the banks, basically.
As long as they do. That's
perhaps lessons have been learned from 2008 in terms of the regulators, but
we're a better precedent from that point of view. Any questions? Yes.
Yes, you said that there was poor performance in 2022, and we've started this first quarter with not a great performance, if not a poor performance. Do you think that's characteristic of the markets, or do you think that's more characteristic of Brunel's in the market?
It's a function of the fact that Brunel they've got this very responsible investing approach.
Yeah.
They don't have many, so they have low holdings in the energy companies, and when they performed very well in 2022, particularly in the first half, so Brunel was left behind from a performance point of view. That's kind of beginning to change a little bit, and I mean I think we give them credit. Brunel are outperforming in Q4 on virtually all their funds. Q1 they're kind of outperforming from the sound of it so far, but quarter to date, so that is encouraging. I mean I think to be honest, I think we'll be. I think it was mentioned earlier on, actually, they've got a lot of performance to claw back, to get back to good long-term performance. And I think we'll be saying the same thing for much of the next few quarters, even if they perform, quite well. I don't think they're going to have stunningly good performance. They may be able to beat the market in 2 out of 3 quarters, or 1 out of 2 quarters, or whatever. But they've got a long way to claw back to improve their long-term performance, basically. So I think we're right collectively, and as Councillor Beasley mentioned earlier on, in terms of to focus on investment performance and put pressure on them to make sure they keep their performance improving, basically. But I think it is a symptom of the fact that, as we've sort of discussed in the past, they've got a very responsible investing approach. And as I've described in the past, my challenge to them is, in 2021, were their managers overpaying for some of the kind of very green investments that they were making at that time? That's the challenge, I think, including the technology arena. They've been overlooking technology stuff.
Anything else, Steve?
Sorry, can I just explore that a bit further?
Yes.
So, because I didn't get a clear answer. So have Brunel not been performing to the standard that we would have liked them to be? Yes or no?
They have not been performing.
Thank you. And I think we've rather danced around that, and I'm beginning to get irritated about it. I think, when we had Investec and they were an issue, we dealt with that, I thought, really rather well. And I just think we need to be slightly more robust in our dealings with Brunel, because if they're not up to snuff, we should A, say so, and B, we should be requesting a plan for improvement. And I'm getting lots of sympathy for their financial and employment situation, which I'm afraid to say I haven't got quite the same sympathy. They're all being paid squillions. It may not be as much as they like. Oh, yes, they are. And, us poorly paid councillors are sitting whilst they want another 100 grand. And I'm thinking, hey, get the performance right before you start, because that's what would happen in business.
Yeah. Steve, want to comment on that?
Yes. So I mean, we are focusing on their performance. I mean, you've read my previous report where I've laid it on the table, and I am critical of Brunel. That in writing, it's in our report. I'm making it very plain. Their plan is to improve performance. David Vickers was at the last meeting. I mean, he'll come to the Chief Investment Officer. We made it plain then. I think we've had discussions about what should be our plan B in the past. Because what do we? I think that's something I would encourage the committee and myself to think more about, maybe at a training event or something like that. What if in another 3 years' time performance were to be very poor on a long-term basis, what would we then do about it?
Councillor Roberts.
Yes, thank you. I really wanted to back up Peter Wharf's comment about Investec. If you remember, I think we had 3 meetings with them, and the fire got fiercer and the more senior officers got closer to it until we ended and took it away from them. I don't believe that we're doing this effectively to Brunel, and I think we need to. And it worried me in the report on the advice that we are being directed to 100% funding, and it leaves us with little room other to go with Brunel. I'm seriously worried that we are not holding them to account enough. And we saw this, I think, on some of the ESG stuff that was happening last year. And I suspect a couple of the other pension funds possibly have a little more influence on that, notably the Environment Agency, which is going full bore on 2030 as a government arm, which is surprising when the government is going to 2050. And I'm really worried that we are a small voice in Brunel and they are not being held to account enough. Thank you.
Yours.
Yeah, well, I've noted those comments. We'll continue to scrutinise them. I think, as I say, I think in order for that to have meat, one has to have a plan B. One has to know what the alternative is.
Yeah. Okay.
Well, I agree entirely with Councillor Wolf and indeed the well-made comments by Councillor Mark Roberts. To put this in a very simple context and look at a number of areas, the point with Silicon Valley, as I see it, is a non-diversified bank, one sector caught out by rising inflation. And where we are with Brunel, we can all ask interesting questions, and I can ask a question of you. If you had pension funds and you had 2/3 with Brunel, would you be tempted to transfer the other third to Brunel? And the answer is probably no. So those are the basis of concern, but also there's the concern that we should have in terms of being risk averse and what potentially could happen in a very uncertain world. We've had mention, for instance, of BP, and I'll throw this into the ring, where BP has been in Azerbaijan for 30 years or so. But if we suddenly found that there were difficulties in Georgia or Azerbaijan, etc., how would this play to the world economy, and how would that impact on our pension funds? i.e., are we sufficiently defensive with our pension funds, given that there could be more future world shocks? i.e., we saw the world shock last March with Ukraine. Are our investments sufficiently risk averse?
I think this is one of the big issues we will need to look at as part of the strategy review. Because it is still possible to develop two very different economic scenarios going forward. One where inflation is doggedly high and one where inflation collapses. And either one of those two alternatives might have a very different impact on what we'd want to do as an investment manager. But there's a body of work that needs to be done.
Yeah. So the risk of the investment structure will be studied in the strategy review. So there'll be the firm that are going to conduct it are going to they will look at downside risks, scenario risks. So you will see that range of possible outcomes for the fund based on the current strategy and based on a potential future strategy review. So I think that will be dealt in that process in the next 3 months.
Yeah, Councillor Begg.
Could we have a report in the next meeting we have about what is involved in preparing a plan B? I'm not saying present a plan B. I'm saying let's see what we can do about it and what the options might be and what it will cover. Because I've been concerned about Brunel, who always have seemed to say, yes, but we will do better. I would like Investec. And yes, they are a little bit at the moment, but they're saying they can do better, but they can't say how they're doing better or what's driving it. And that's what worries me. Yeah. Yes, it's fine on the surface to say what you're going to do, but what's underneath it to support it? And that's what I'd like to know about where Plan B might be.
Steve, we'll take those comments on board and be part of the work we're planning to do.
Okay. So I've got the Plan B. So I've got the Plan B sort of documentation, something around that. The second thing, and obviously these questions need to be these points need to be made strong, forcibly to Brunel. I mean, I do it, Dave does it, and we've had an opportunity to do so this morning because we didn't have the representatives at the meeting earlier.
Let them know we're looking at a Plan B. That would help.
Yeah, it certainly wouldn't do us any harm to let that.
I agree with that. I agree with that. I think the very existence of knowing that there are we look into alternatives. But I think that would require quite a lot of, I don't know whether there's in the client group of officers and other funds. It'd be good to know what other funds are thinking as well.
But let them know what we're thinking too.
Yeah.
Can I come back with another question?
Yes. Sure.
Different one. It's going back to your benchmarking. If you want to compare rates of inflation, for example, whether it's CPI or RPI, you know that the government produces a figure every month, and therefore you can take a 12-month figure over any particular 12 months. You can do it at any monthly period, up to 12 months. I'm a bit surprised that your benchmarking you're talking about, there was a 3 months difference. Don't benchmarking have more or less a continuous flow of data where you can actually pick the period of time you want yourself?
Yeah, but the benchmark is not available. So the benchmark for the property index, when the data is first collected by State Street, Brunel, Dorset, I'm looking to Dave to help me with this, which is a date in somewhere in mid-January. The end of December data for the benchmark of the property index is not available by that date in late January, I think it is.
Why can't you have one for the end of November?
Well, good question. I asked that very question myself. So I think we're going to take some of those things forward. Yeah, I agree. Yeah,
I actually don't think you should be too worried about this because partly it comes out in the wash, literally. I mean, if a delay is against us in one period, if there's every the same delay in a different period would be helpful. So there's not inherently a problem with that.
Well, there is. Sorry to interrupt you, Chair, but there is, because if you're trying to decide on some action or evaluate a situation, you need to have data that's reliable and usable. And if there's a 3 month gap between one and another.
But I mentioned that because if you take it from the point of view of something like property, when a valuation is done, I mean, with all the best will in the world, they come up with an idea of what it be worth. If you actually try to sell it, what is your percentage chance of actually getting the price they set? And in some markets, when the property is soaring upwards, you might suddenly find you leapfrog forwards and do better than you expected. But equally, in times when property is performing poorly and the markets are difficult, if you try to sell a decent amount of property to raise money, you'll suddenly find the valuations are not worth what they're written on, and the price you get is much lower.
Yeah.
So I think it's much harder with these illiquid. All private market stuff is much harder to judge directly in comparison to the public market.
But I agree that in the case of the property, would be worth asking State Street if we can somehow incorporate the end of November data for the benchmark, because it would only be 1 month out rather than 3 months out. That seems to me a sensible.
Yes, sure. David.
Yeah, sorry, all I was just going to add, because Steve says it in his report, saying as a minimum, I'd suggest this be investigated further and see if there's anything we can do, which we'll look at.
Okay, in that case, we'll move on to your report, David.
Sorry.
Thank
you, Chair.
Oh, sorry.
Yeah, just going back to again, it's a useful report, and I like the sort of insight we get from it. Going back to the point about the shift to higher medium-term interest rates, and after a long period of low interest rates that people have got used to, and that's exposed sort of certain gaps. And as was mentioned, the Silicon Valley Bank is one of those. I agree with you. It doesn't look good, does it? Especially when it's called the Global Sustainable Equities Fund, and one of the investments couldn't even sustain its existence because of changing interest rates. So not that sustainable. It just doesn't look good. But the issue for me is that it's about contagion and about exposure to that sort of area. Is there anything we can do to look at those investments with Brunel to just be informed about whether we have any investments in similar sort of small banks? That's the second US bank that's gone, or partly over the concern about sort of contagion, or just are there others in that where the sort of longer medium term interest rates are going to impact those, and do we need to be sort of getting a view of that, and just as an early stage? I don't like to come to these meetings and say, oh well, this week the news is this, what are we going to do about it? But you need to sort of be aware of these things at an early stage, just in case.
I was just going to go back to the presentation that Luke O'Donnell did from Brunel at the beginning, in that we are expecting, I had hoped that we might have the note before the meeting from David Vickers, the Chief Investment Officer at Brunel, a briefing note on what the implications are, because this is, this isn't the sole implication. The fact that we had this underlying investment worth to us probably about 1.5 million of that sort of magnitude. But there are the concerns about contagion. There's also the fact that a lot of the private equity underlying companies, private equity holdings, not just with Brunel, but also our legacy holdings with Harbour Vest and probably Aberdeen as well, that a lot of the underlying investments used this bank, so it's contagion, but it's also about understanding what the relationships are at that lower level with this particular bank. So hopefully we'll when we have that briefing note, we'll obviously share it with the committee, and hopefully that will address some of the concerns that we all have. I think we'd be having a much different conversation if we were having this conversation on Friday before the weekend, because in the UK and the US, the bodies clearly took big steps to try and dampen down that risk that you talk about, the of contagion, that you see a run on one bank transferring to runs on other banks.
I think also, bearing in mind the past, I remember the media ringing up to ask about Russia when we were in Ukraine to start WhatsApp. I think you should anticipate that the media will at some point ask about this as well. So if we could look at this briefing comes very soon, hopefully, and then we can look at maybe want another press release or something that anticipates that they want to know that information at some point. Okay. Anything else? No, in which case, out to you, David.
Okay, thank you, Chairman. Even by my own standards, I'm going to gallop through this really quickly, because I think, one, because we haven't got much time, and also because a lot of things that I was going to say have probably been covered already in terms of the Fund Administrator's report, in terms of the talking about performance, what's driven the performance. So the only thing that I am going to say is, in addition to the regular content in the report, we've also included an updated version of the funding strategy statement, which has been developed with our actuary following the conclusion of the triennial valuation. So the funding strategy sets out the funding objectives, what the purpose of the fund is, to be blunt, who the key parties are and what their different responsibilities are. It also includes a summary of the results of the valuation and a summary of the assumptions. And it covers some of the ground that Karen Gibson talked about earlier in terms of the treatment of things like the cloud, etc. And it sets out the arrangements for employers who wish to join the fund or who wish to exit the fund as well. And it also talks about the risks. One thing that is buried in there that you might see is that there's talk about changing the valuation cycle for LTPS funds away from 3-year to 4-year, but at the moment there is no firm decision has been made on that. The actuary's working assumption is that the next valuation will be in 3 years' time, as it has been before, but obviously as and when, if that changes, then that will be brought back to the committee. So the next step with the funding strategy statement is that we will publish it and we will make it available for comment primarily from other scheme employers, and then for that to be finalised by the time the committee meets next in June at the latest, but potentially sooner than that. We may well do that just through email, depending on whether and what comments we may get from scheme employers. Pause very briefly, but then I'll jump onto the next paper, if that's okay. So the next paper is item 13, Pension Fund Treasury Management Strategy 23-24. So this is this is the parameters, if you like, that the officers can operate within in terms of managing the cash balances that the pension fund, the flow in and out of the pension fund. So we don't have a strategic allocation to cash, but just by the nature of the fact that we've got in the region of about £140 million worth of contributions coming in, and just under that value of benefits going out, plus other property income, divestments from investments and investments in new investments going on. So it's just the parameters within which we manage those cash flows. The strategy and the limits are unchanged from 22-23, and the strategy for the pension fund continues to be broadly in line with the strategy of Dorset Council, the administering authority for, if you like, for managing Dorset Council's funds. The Dorset Council strategy is wider because there's a lot more in borrowing on that than there is in here. So it's just looking for the committee to approve that strategy for 23-24.
Okay. Any questions on that?
Just one. So this year we've had confirmation that the annual revaluation by CPI is 10.1%. So that will impact on the amount of cash that we have and that's going out. So I'm quite sure that the incoming won't be quite as much as the 10.1 that we're paying out. But as you're saying at the moment, we have more income coming in to keep us relatively neutral.
Yeah.
And is that the forecast for the forthcoming year, do you think?
Yes, yeah, still broadly neutral. So yes, as you've said, benefits will be going up.
Yes.
By just over 10%. Yeah. But in addition, contributions coming in as pay awards are, yes, well, not just pay awards, but as people progress through scale points, if you like, on their salaries. So yes, the contributions from employers are based as a percentage of payroll. So the two won't match precisely. Yeah. But it will mean that gap is kept to a relatively.
So broadly, you're saying there's that 5 million positive from last year, and that should be enough for us to proceed with this year and still remain cash neutral.
Yeah. Sorry, can I? Yeah. I mean, our funding percentage is just over 90%, isn't it?
Yeah, that's I
know it's different.
Sorry,
but you can't talk about that without talking about, we're only 90% covered, so we're 10% short. So I think you're in danger of saying, oh well, ins and outs are the same, but we're short by 10%, which represents a very large number of millions. So I think both need to be talked about together.
Yeah. I think the point, just to clarify, what we're talking about is the cash that's coming into the fund and the cash that's going out.
I know, but that's a very short-term measure. The long-term measure is our funding percentage.
Yeah.
Which was 96.
Revenue, and Peter's talking capital.
96.
Yeah.
Mark,
thank you.
Yeah, I think it's just been mentioned that Barnett Waddington actually said we were now 96 in her latest review, which is gives us a little more encouragement, Peter.
Yeah, it does, but
still not 100%.
To put it in perspective, one of the applicants that we interviewed the other day talked about the Pension Board independent person talked about the authority they had was funded at 120%. So there are clearly some councils in a lot stronger position than we are.
But we have got some councils within Brunel who are 75%. So
yes. Well, I think the conclusion I wanted to present for the committee was that we're not at risk of having to take some of the capital out to fund our cash commitments throughout this year, particularly. And when we get to next year, and we know that CPI is still at 10% or has dropped to 5%, and we can review it again, can't we?
Yeah, and I think that the next time that we will review it in more detail is when we do the valuation. Next time we do the valuation, and then there will be an opportunity. We will need to take that into consideration when we're looking at our investment strategy. So that's something to bear in mind. If you put too much into illiquid assets, in time we will move to a point where the contributions that are coming in aren't sufficient to pay the benefits going out, and we will need to be selling assets or selling the capital to pay for that. And that's what the fund is there for. That's what the 3 billion of 3.4 billion of assets are there is to fund those pension promises that we've made in the future.
Thank you.
Anything else?
Yeah, just on the treasury management strategy report. I don't have an issue with it, and obviously it's the Dorset Council sort of treasury management strategy, which I'm not particularly familiar with as a BCP council. I'm fairly familiar with the BCP's treasury management strategy, and that gets approved at our budget council each year. And there were changes made to it. I don't know if there's any ability to do a quick comparison between the Dorset and I can't imagine there's any significant differences, or in terms of the terms and the scope and the approaches and the strategy between the Dorset Council treasury management strategy and that of BCP. But I don't know whether that's ever looked at, or whether there's any scope to do a quick look or speak to somebody at BCP to see how it compares, because those of us.
I'm certainly not aware that that's happened in the past.
No, personally, I don't think that's necessary, because this is almost like the pension fund treasury management strategy is almost like a subset of the wider council ones. The council ones look more at borrowing. They look more at your different types of investments as well. Whereas for the pension fund, we have the investment strategy statement, which talks about the equities and the bonds and all of this. So this is much narrower. It's looking at the cash, the things that we have in there, majority of which, this is what we could do or what we can do, as opposed to what we will do. In reality, we manage our cash quite simply. Primarily it will be in low volatility money market funds that give us instant access, etc.
That's right, because the treasury management strategy will define those sort of funds that we can invest. We can keep our cash, with the sort of mattresses that we can store our cash under, so to speak.
But presumably this would be a public document.
Yes.
So if you wanted to have a look, you could.
Yes. Goes out with the annual budget.
Yeah, Dorset Council. Yeah. So 14th of February, Dorset Council approved the budget strategy, and one of the appendices to that was the council's treasury management.
I could look at that and see if anything leaps out at me.
You're welcome to have a read of it. Yes, by all means. Okay, anything else? No. Yeah, good. Okay, on to dates of future meetings, which are there before you.
Yeah, I wonder if could we sort of come. So these are for the meetings of the committee, they're not for training. I wonder if we could come back to training as part of the the next item, the exempt item.
Yes, could one of you please move that we're going to
I'm happy to move that we're going to exempt proceedings.
Yeah, second that please. All those in favour? Anyone against? No.